Let's cut straight to the numbers every Canadian with a CPP account should face today. The Canada Pension Plan has amassed total assets of $780.7 billion, marking an all-time high. It safeguards the retirement security of 22 million Canadians. Astonishingly, $366 billion, nearly 47% of the entire portfolio, is invested in the United States, American stocks, real estate, private equity, and fossil fuel infrastructure. All of this is tied up in an economy currently engaged in an active trade confrontation with Canada, slapping 25% tariffs on Canadian steel and aluminum, challenging Canadian economic sovereignty, while its currency has dropped 9.5% against major global currencies in 2025. Meanwhile, the fund maintains just 13% in Canadian assets, a historic low compared to 74% back in 2005. Combined, Canada's 8 largest pension funds, the Maple 8, hold $1 trillion in U.S. assets out of roughly $2.6 trillion in total managed wealth. This means Canada's retirement system is nearly half dependent on a foreign economy. The Ontario Municipal Employees Retirement System reported $1.7 billion in unrealized foreign exchange losses in 2025, largely due to U.S. dollar depreciation. Likewise, Quebec's lease depot acknowledged that a weakening U.S. dollar negatively impacted fund performance, necessitating $3.6 billion in hedging activity just to stabilize the value. The Ontario Teachers' Pension Plan slashed its net U.S. dollar exposure from $90.9 billion to $41.3 billion within a single year, reducing exposure by over 50% after their CEO identified the risk of a deflationary U.S. dollar. The pension vulnerability is tangible, documented, and already affecting Canadian retirees today. To understand how CPP reached 47% U.S. asset allocation, we need to look at history. In 2005, the Canadian government lifted foreign ownership limits for pension funds and RRSPs, which had previously mandated 74% domestic allocation. The policy aimed to allow global diversification, avoid excessive concentration in Canada, and seek the best returns internationally. For the following 15 years, this strategy succeeded. U.S. equities far outperformed Canadian stocks throughout the 2010s. American technology companies delivered unmatched returns that Canadian investments could not replicate at scale. The S&P 500's compounding returns directly contributed to CPP's 10-year annualized net return of 8.4%. Since 1999, the fund generated $543.4 billion in cumulative net income, with a significant share coming from U.S. equities. The fund's representatives defended this exposure, noting that U.S. stocks simply performed well, and that prudent investment decisions reaped these gains. They are correct. The fund exceeded actuarial projections by $75 billion in 3 years. Canada's chief actuary confirms that the base CPP remains financially robust, projecting sustainable retirement income for decades. The fund is not in distress. Instead, it carries a specific quantifiable structural vulnerability, actively monitored by its executives. According to official CPP disclosures, a 10% appreciation of the Canadian dollar against all other currencies would automatically reduce net investments by $55.6 billion. This is a mechanical accounting effect independent of poor investment decisions or market crashes. The U.S. dollar has already weakened 9.5% against major currencies in 2025. Former Ontario Pension Plan CEO Jim Keohane explicitly warned that political instability could further weaken the U.S. dollar, potentially overpowering returns from U.S. assets. The word overwhelm captures the precise financial reality. An 8% U.S. equity gain could result in a net negative return when converted to Canadian dollars if the U.S. dollar falls by 9% simultaneously. Investment returns are tangible, but currency losses are equally real. Today, the U.S. dollar faces structural pressure from $39 trillion in national debt, declining global foreign reserve demand, and a Federal Reserve constrained by fiscal dominance. This risk is structural, not cyclical, and it directly threatens Canadian pension returns. In February 2026, OMAR's President Blake Hutcherson declared that the fund would not confront the pressures of a weakening U.S. dollar in isolation. The organization shifted its currency management from a fixed hedge ratio to a flexible, multi-objective framework. The previous strategy, once effective, no longer suits today's economic climate. Within a single year, Ontario Teachers cut its net U.S. dollar exposure by more than 50%. Meanwhile, the Toronto Transit Commission pension plan is deliberately increasing European holdings to diversify away from concentrated U.S. currency risk. Smaller Canadian pension funds have reduced their U.S. dollar borrowings to a 6-year low as they pivot toward alternative currencies. Senator Clement has called for a formal Senate inquiry into how Canada's major pension funds manage foreign asset exposure, explicitly highlighting the dangers posed by geopolitical tensions or hostile policy changes abroad. In January 2026, executives from the Maple 8 met with Finance Minister Francis Philippe Champagne, to discuss reevaluating U.S. allocations and boosting domestic Canadian investments. Champaign subsequently established quarterly sessions with all 8 funds. At the highest levels of pension management, the discussion has shifted. The question is no longer whether U.S. exposure is excessive, but how swiftly and to what extent it can be reduced, all while honoring the fiduciary duty to avoid sacrificing returns for political considerations. The CPP faces the greatest challenge, holding $366 billion in U.S. assets and carrying a fiduciary obligation to 22 million Canadians, while operating in a geopolitical context that renders its largest geographic investment politically fraught. Every Canadian finance minister, pension board chair, and retiree tied to the CPP must confront this question. With the fund's biggest geographic commitment exposed to structural currency pressures, increasing geopolitical risk, and federal pressure to repatriate capital, what does reallocation look like in practice? What are the consequences if adjustments proceed too fast or too slow? Statements from the Maple 8's own executives reveal more concern than public messaging suggests. In February 2026, Blake Hutcherson emphasized OMR's intent to contribute to a more resilient Canadian future. OMR, with 55% of its $141 billion portfolio in the United States and just 16% domestically, is actively exploring nation-building opportunities within Canada. Hoops's chief investment officer, Michael Wissel, confirmed that available capital is waiting for domestic investment projects to emerge. PSP CEO Deborah Orita stated her fund is actively searching for additional Canadian allocations, questioning internally whether it has underutilized its home market advantage in CPP investments. CPP CEO John Graham expressed optimism about Prime Minister Carney's efforts to develop large-scale investable domestic projects, but noted an opportunity deficit. The capital exists, but the domestic pipeline is not yet sufficient to absorb it. This mismatch between intended investment and deployable opportunities is one of the most underreported tensions in Canadian pension management. It also explains why moving U.S. assets back to Canada too quickly could endanger beneficiaries financially. Fund managers cannot simply respond to political pressure without considering the law. The CPP's mandate, as codified in the Canada Pension Plan Investment Board Act, requires achieving the highest possible returns without taking undue risk of loss. This obligation is strictly fiduciary. It is not conditional on national interest, political alignment, or trade war positioning. 22 million Canadians rely on the fund's performance for their retirement. CPP representatives stress that decisions are never impulsive or arbitrary. Chief Investment Officer Edwin Cass underlined that the fund remains a long-term investor, pointing to infrastructure assets in Mexico, Chile, Indonesia, and India that continue to perform strongly. Reallocations away from U.S. assets, therefore, aim at global diversification rather than exclusively Canadian investment. The fiduciary constraint is concrete. Rapidly liquidating $50 or $100 billion in U.S. equities would force sales at prevailing market prices, potentially during periods of weakness if motives were publicly visible. Redeploying such sums into the Canadian domestic market, which analysts consistently describe as too small to absorb this level of capital, risks compressing returns. Canada accounts for roughly 3% of global market capitalization. With CPP already holding 13% domestically, it is, by this benchmark, an overweight position. Pushing Canadian pension funds into higher U.S. asset allocation through political influence rather than investment rationale would directly violate the fund's founding mandate and could expose the government to legal challenges from beneficiaries. The Maple 8 collectively manage $1 trillion in U.S. assets. The CPP alone has $366 billion invested across American stocks, infrastructure, real estate, and private equity. If even 15% of that $1 trillion begins shifting out of U.S. markets over the next 3 to 5 years, driven by currency hedging, domestic repatriation pressure, and geopolitical risk repricing, it could generate $150 billion in selling pressure on American equities and real estate. This would occur gradually, not as a sudden shock, but consistently and at institutional scale. CPP's holdings span American airports, pipelines, data centers, real estate investment trusts, and private equity portfolios across every major sector of the U.S. economy. When investors of this magnitude change allocation direction, the impact extends far beyond their own balance sheets, rippling through asset prices, deal flow, and credit markets in the sectors they exit. RERS has already indicated a shift in currency issuance strategy, moving from a fixed U.S. dollar debt issuance ratio to a flexible multi-currency model. Ontario teachers reduced net U.S. dollar exposure dramatically and spent $3.6 billion specifically on currency hedging to mitigate depreciation risk. These are not peripheral funds reacting emotionally to news headlines. These are highly sophisticated institutional investors with dedicated quant teams, global macro experts, and decades of cross-border investment experience. They are all simultaneously reducing their concentration in U.S. dollars. The pressing question for Canadians and Americans alike is clear. What happens if the US dollar drops another 10% from current levels? CPP's own financial disclosures provide a precise answer. A 10% appreciation of the Canadian dollar against all currencies would mechanically reduce net investments by $55.6 billion. This scenario does not require a market crash. It is a currency-driven impact. The US dollar has already weakened 9.5% in 2025. Several senior pension executives have publicly stated that this depreciation is structural, not cyclical, driven by record US deficits exceeding $1.8 trillion annually, declining foreign demand for Treasury bonds, and a Federal Reserve caught between lowering rates to support growth and keeping rates high to defend the currency. If the US dollar continues along its 2025 trajectory and falls another 10% through 2026, the Maple 8's combined $1 trillion in US assets could experience over $100 billion in unrealized losses purely from currency fluctuations rather than poor investment decisions. Senator Clemens' call for a formal Senate review of how Canada's major pension funds handle foreign exposure is not political posturing. It recognizes that the intersection of geopolitics, currency risk, and fiduciary responsibility has created a complexity that fund managers cannot resolve alone. The Canadian government cannot legally compel pension funds to reduce U.S. exposure, but it can build a credible domestic investment pipeline, large-scale infrastructure, clean energy projects, housing, and broadband that offers competitive returns relative to U.S. assets. This pipeline is precisely what Finance Minister François-Philippe Champagne's quarterly meetings with the Maple 8 aim to develop. It is also the solution John Graham referenced when discussing Canada's opportunity deficit. Canada possesses the capital and the funds. What has been lacking is a domestic project pipeline that is sufficiently large, bankable, and return competitive to attract institutional capital accustomed to 20 years of American market depth and liquidity. The so-called $400 billion pension trap is not a result of poor investments. It exists because the geopolitical environment shifted faster than the portfolio could adjust. 20 million Canadians depend on 47% of their retirement savings performing in an economy where their own government is engaged in active economic conflict, the currency is under structural pressure, and political conditions have introduced unprecedented uncertainty. Senior pension executives are publicly flagging these risks for the first time in a generation. The fund is not collapsing. It is not failing. But the circumstances that made a heavy American allocation a brilliant strategy for 2 decades have changed dramatically. Institutions managing Canadian retirement savings are navigating these challenges in real time, overseeing $780 billion in assets. If this raises issues your financial advisor hasn't addressed, it is essential to understand the stakes. Share this analysis with any Canadian holding a CPP account, and recognize that retirement security is actively managed through the most complex geopolitical environment seen in a generation. Thanks for watching. See you in the next one.